Hello everyone, my name is Anagha Deodhar and I'm the Chief Economist for ICICI Securities. Today I'm going to be talking about the important economic developments that happened during the month of March 2021. And here I'll cover the inflation prints that came during the month, which is the retail inflation and the wholesale inflation. Then I'll talk about the government finances data. I'll talk about the industrial production and core sector data and the foreign trade data. So these high frequency indicators, when we piece them together, they give us a good sense of how the economy performed during the month. So let's start with the inflation prints. There are two types of inflation. There is the CPI, which is the consumer price index, and this reflects the inflation consumers like you and I face. And then there is the wholesale price inflation, and this talks about the inflation producers or manufacturers face. So if we talk about CPI is the most widely tracked or the most important high frequency inflation number that is there. And everybody, right from firms to the RBI and the MPC, all of them track this number very closely, and a lot of economic decisions are based on the CPI inflation print. So the CPI inflation, the number that was published in March 2021, that was for the previous one, that is February. And that number showed us that CPI inflation for February was 5%. And what this means is that compared to February 2020, the prices of goods and services increased by 5% in February 2021. That is to say that CPI inflation was 5% year on year. And the trend that we have been observing with CPI inflation in the past few months is inflation has started coming down. Now, soon after the COVID lockdown restrictions were put in place, inflation increased sharply, and that is because there was a big supply shock. There were restrictions on movements of goods and services, and this supply shock led to a big jump in inflation soon after the COVID lockdown was imposed. But as the lockdown restrictions eased gradually, so did inflation. Starting the end of last calendar year, inflation started easing, and it has been easing persistently. Now, February 2021 was an aberration to this trend, and that is because the base effect for February was high. Now, the base effect is a slightly technical term, so I'll not get into the details of that. But the bigger picture is inflation has started easing. And the main reason why inflation is easing is the deceleration in food inflation. Now, food has a very high weightage. Food accounts for 46% of the CPI basket. That's almost half of the CPI basket. And hence, if this component is recording very high inflation, the overall basket will also record very high inflation. And this is what we observed last calendar year after the COVID lockdown, that because of food, headline CPI inflation remained very high. And in the last few months, because of a number of reasons, because of the fresh foods, grains, food stock entering the market, because of easing movement restrictions, easing lockdown restrictions, and because of more certainty, a lot of these food prices have started coming down, because of which headline inflation has also started coming down. So within CPI, if you look at the components, the share of food inflation in the basket has been coming down. But on the contrary, you have the services component, services inflation, which has remained high and which is increasing. And this is very interesting because, if you look at a lot of these service providers, services are typically contact intensive activities. For example, if we look at hair salons, it falls in the service sector. And because of COVID, their transaction costs have gone up. So if you visit any hair salon, you will see that now they're charging 100 rupees or 200 rupees as a flat convenience fees, which goes towards cleaning the place and following COVID guidelines. And they're also operating with lower staff. So the COVID restrictions, the lockdown restrictions have increased the costs for service providers, and this also includes restaurants. This also includes movie halls, a lot of these services. And because of this, the service inflation has remained high and has been increasing. But still, the deceleration in food inflation is far outweighing the increase in services inflation. And as a result, the headline CPI inflation has been coming down. So, if we look at the first 11 months of the fiscal year, now we have CPI inflation data from April 2020 to February 2021, and that is 11 months of FY21. The CPI inflation has averaged 6.2% in these 11 months, and we do expect inflation to remain high in March as well, because the base effect, similarly for February, the base effect for March is also quite high, because of which CPI inflation could print anywhere between 5.3 to 5.4% in March 2021. And as a result, we expect headline inflation to average around 6.2% in FY21. So this is the CPI, or the retail inflation. Now if we move to wholesale inflation, or the inflation that manufacturers and companies and producers face, that is showing a completely opposite trend to CPI. CPI has been coming down, but WPI has started going up in the past few months. And the main reason for that is some components of the WPI basket, for example, base metals and chemicals, they are recording very sharp price increases. Steel prices in particular, steel and other base metals have started increasing. And these products have relatively higher weightage in the WPI basket. So WPI for the month of February 2021, the data which was published in March, that came in at 4.2%. Now let's talk about the industrial production data that was released during the month. So here let's first consider the core sector data. And core sector comprises of 8 infrastructure industries, and this includes production of cement, steel, electricity, petroleum, fertilizers, etc. So this is a very important indicator, because this shows how production of these very important commodities has been during the month. And core sector also accounts for more than 1/3 of the IIP, which is the Index of Industrial Production, which is taken as the most widely tracked indicator of industrial production. That's why core sector data is important. And the core sector data for the month of February showed a contraction of 5%, which essentially means that the production of all these industries that I just mentioned, steel, cement, electricity, petroleum, etc., the production of these industries was lower by 5% in FY21 compared to FY20. And this is not a very encouraging sign, which means that industrial production in for the month of February will be lower, because core sector is a determinant or a component of IIP. And core sector along with IIP growth has not been very good since the beginning of COVID, understandably so, because the economy went into a lockdown, and the production of all these commodities, all these sectors almost came to a grinding halt during the lockdown. The past few months, core sector has either contracted or it has recorded very modest positive growth. So nothing encouraging. Same goes for IIP. It's not very encouraging, and it will be at least a while before IIP and core sector start showing positive growth on a sustained basis. For any meaningful growth to happen in these sectors, it could take a while. And if we talk specifically about FY21, the biggest sectors that pulled down the core sector growth into the red were petroleum, coal, and electricity. So WPI for the month of February 2021, the data which was published in March, that came in at 4.2%. And that was sharply higher, because in January, the preceding month, WPI inflation was just 2.2%. So there is a 200 basis points increase in WPI inflation in just 1 month. And this is a worrying sign, because this means that producers are facing rising prices, rising input prices, and either they will have to pass on these increasing input prices to consumers, or they'll have to take a hit on their margins. Another interesting data point that we witnessed was the wedge between, or the difference between WPI and CPI. Now, the baskets, the WPI basket and the CPI basket, they're quite different because, like I said, one reflects the consumer prices and the other reflects the producer prices. So the baskets are quite different. But still, typically, the difference between WPI and CPI is taken as an indication of margins or the indication of bottlenecks. So what we are seeing is the wedge between CPI and WPI has fallen to 90 basis points in February 2021. And soon after the COVID lockdown restrictions were put in place, that is April and May of last year, the wedge was very high. And now it has progressively relaxed to 90 basis points, which is at a multi-month low. And this shows that the supply side bottlenecks, or the profit margins that the trade margins that retailers are charging, those have started coming down, and this indicates easier movement of goods and services across borders. Now, a quick look at the merchandise trade data for the month of March. These are provisional numbers. The full numbers have not yet been published yet. But if you look at the provisional numbers, they show a very good growth in merchandise trade for the month of March. Total exports stood at $34 billion, and this is a 58% increase year on year. Similarly, you have the core exports, which is exports excluding petroleum and gems and jewelry. Those have come in at $27 billion, and this is a growth of 61% year on year. So both of them have shown a very robust, very healthy growth in March. Similarly, if we look at imports, our total imports are at $48 billion. And the non-oil, non-gold imports, which is core imports, just consumption items and investment items, if we exclude commodity and gems and jewelry. Non-oil, non-gold imports have also come in at $27 billion. So in total imports, it's a growth of 53%, and in non-oil, non-gold, it's a growth of 45%. So both these, all the trade numbers, whether it is headline imports and exports, or core imports and exports, all of them have shown a very good growth. But partly this is also because of a very low base effect. So if you look at March last year, because of COVID lockdown and because of the world economy not doing so well because of the pandemic, India's imports and exports had recorded deep contraction in the same month last year. So our total exports had declined 34%, and our total imports had declined 28% in March 2020. And on this low base, the merchandise trade numbers for March 21 are showing very good growth. So, if we account for the low base effect, it just shows that our trade is reverting to the pre-COVID trend that was there. And as a result, we have the trade deficit for the month of March that has come in at $14.1 billion. And in the last month, that is in February, it was $12.6 billion. So there is a marginal widening of the trade deficit. Now, a couple of important policy developments that have happened during the month. I'll quickly take you through them. Firstly, the PLI scheme, the production linked incentive scheme, was announced for the food processing sector. You would be aware that the government has already announced PLI schemes for a variety of sectors. They cover a wide array of manufacturing in the country, and now food processing is the latest sector to get added to it. The total outlay on PLI for food processing is 10,900 crores, and the government expects that it will generate employment of 2.5 lakh people by FY 26-27. So this is a continuation of the government's focus on boosting manufacturing within the country, and it is likely to yield good results. The second development is the inflation targeting, the flexible inflation targeting framework that we have, that the RBI and the MPC follow. The government has decided that the target for this flexible inflation targeting will continue to remain at 2 to 6% for the next 5 years. This was also a recommendation of the RBI paper on the same topic, and the government has accepted the RBI's recommendation on this. And the third development that we have is a very encouraging development is the GST collection for the month of February has come in at 1.23 trillion, 1.23 lakh crore. And this is the sixth month in which the GST collection has increased, has crossed $1 trillion rupee mark. And this shows that the economy is genuinely witnessing a pickup in activity. Genuinely, the demand is coming back. And also, this also partly reflects the government's effort in curbing tax evasion and in improving compliance to GST. So, these 3-4 important developments and the data points I mentioned sum up the domestic economic developments during the month of March. The past few months, core sector has either contracted or it has recorded very modest positive growth. So nothing encouraging. Same goes for IIP. It's not very encouraging. And it will be at least a while before IIP and core sector start showing positive growth on a sustained basis. For any meaningful growth to happen in these sectors, it could take a while. And if we talk specifically about FY21, the biggest sectors that pulled down the core sector growth into the red were petroleum, coal, and electricity. So that explains the 5% contraction. And the next important indicator I want to talk about is the bank credit growth. This is a very important determinant of overall economic growth, overall economic health. So bank credit growth for the month of February came in at 6.5%, and non-food bank credit, which is almost the entire, the biggest part of bank credit, that also grew at 6.5% in February. And that is slightly up from 5.7% in January. So that is an uptick in a month-on-month terms. Bank credit growth dipped below 6% for a good part of FY21 because of, again, the COVID-related slowdown in the economy. There was no demand for bank credit because production had halted, consumption had halted. And as slowly the lockdown restrictions were eased, economic activity gathered pace, the demand for bank credit came back slightly. There was a modest uptick in bank credit. And we expect that in FY21 as a whole, the average bank credit growth could be just a tad above 6%. So 6.2% is what we are expecting. And for again any meaningful pickup in bank credit growth, there'll have to be a sustained pickup in economic momentum. So FY22 and FY23, when the economy picks up pace and all sectors start growing robustly, that is when bank credit growth could come back meaningfully.